Welcome to this week's edition of Reverse Mortgage Weekly, where we go over all the ins and outs of the reverse mortgage program and dispel all the myths so that you can get some good information about this wonderful program that many millions of Americans are enjoying right now. And really, I was talking to somebody about it today, actually, and that what came up in the conversation is that what a lot of people don't talk about with this program is the peace of mind that comes with it. Imagine being in a situation where you no longer have to worry about cracking that nut every single month to make that mortgage payment. If you have an optional payment, then you can put yourself in a position where you can really enjoy a peace of mind in regards to the reverse mortgage program. So, anyways, I'm your host. My name is Zach Smith. I own Chariot Financial. I've been in the mortgage and real estate industry since 2003. So, gosh, that's 21 years now that we're in 2024. So, I've been voted as a five-star professional by my clients since 2018, certified senior advisor. I don't know if any of you know of that group. It's a wonderful group that really their goal is to look out for seniors and to improve the lives of seniors. And then also, I'm a wholesale mortgage broker. I worked for the big banks for several years, and I decided to go off on my own and start my own broker shop because I wanted to say yes to more people. I wanted to offer better rates and better programs and have a little bit more control over my overhead. One of the things that's happened here as of late is, the mortgage industry is kind of, it's been slow here this last year. So you've seen a lot of these big shops. They got the nice fancy offices. They got all the bells and the whistles. Well, they're not around anymore because their overhead was so high. In 2008, I really learned valuable lessons about how to run a business. And, it's not what you make, it's what you keep. So I digress. Let's go ahead and move on with the presentation here. So who qualifies for a reverse mortgage? You do have to be 62 or better. In some cases we can do a loan at 55 and older. It all depends on the program. It depends on, the state that you're in, things like that. A lot of times we don't use those programs unless we absolutely have to because the benefits aren't that great right now because of the rate environment that we're in. But if you're in a condo complex and you want to do a reverse mortgage, and your condo isn't FHA approved, well, that's the type of program that we'd be looking at that point. So it has to be your primary residence. So 6 months and a day. So, folks will use these programs to purchase vacation properties, take money out of their current home, purchase home in Florida or Texas or Costa Rica or wherever, use those monies for the down payment. And the beauty of that is that as long as you keep your current residence as your primary residence, 6 months in a day, you can snowbird. You can basically go to your other property in the wintertime. And the beauty of it is that you don't have a required monthly mortgage payment. Now, keep in mind, the reverse mortgage does have a mortgage payment. This is something that is not talked about enough. And this is one of the reasons why I started doing these online programs, is because the information needs to get out to the people. So the reverse mortgage has a monthly payment just like any other mortgage. The only difference is that it's optional. If you want to make a payment, you can. If you decide not to make a payment, then, that's completely up to you. But, there's a sentiment that if someone gets a reverse mortgage, that they're automatically going to be upside down on their property. Well, that's really a choice. If you want to continue to make a monthly mortgage payment, you'll never go upside down. So it's a great program because you could pay. Let's say you have a windfall. Let's say you go down to Las Vegas and you win you win the big jackpot, $100,000. And well, where the heck am I going to put this money? Well, you could put it into your mortgage and pay down your mortgage on your reverse mortgage. And then guess what? When you pay that down by $100,000, you still have access to that cash if you need it. So let me say that again. If you put money down on the reverse mortgage and you have a line of credit set up, which most of my clients choose to do, and we'll go over the different ways you can set up the reverse mortgage. But if you put $100,000 down on your principal balance, you're paying the mortgage down, you're still going to have access to that $100,000. And that is key. Equity is great to have, but it's a lot like having a glass coffee table right in the middle of your living room full of cash that you can't get to. Equity is great, but we can't eat equity. And that's the problem that a lot of seniors find themselves in right now, is that they're equity rich and cash poor. That's why this program is wildly popular with seniors, to help access that cash, that glass coffee table full of cash in your living room. You're sitting and you're on your couch watching your favorite show, kick your feet up, and oh wow, look at all that cash. That's great. Well, you can't get to it. So it doesn't really do you any good. It's a lot like having a big suitcase full of Monopoly money, because the only way that it's going to be valuable is if you sell your house. Well, then that begs the question, where do you live? Housing is still the largest expense for almost everybody. So if you have to increase your housing payment, you're going to put yourself in a position where your monthly cash flow is going to decrease, which we're going to go into more detail, but that's not what you want to happen in retirement. You want your monthly cash flow to increase. So most of these programs are FHA. You do need equity or large down payment. So that's something to keep in mind. You do need a significant amount of equity. That's why going upside down on these programs. Remember, the risk assessment for the reverse mortgage, it's just like, it's much different than it is on a forward mortgage. On a forward mortgage, you apply for a forward mortgage, and the first thing the banker asks you is, yeah, we'll lend you some money. How are you going to pay us back? So they're going to vet you. They're going to look at your income. They're going to look at your assets. They're going to look at your credit. They're going to look at all of that information and see, okay, what kind of risk are we taking if we lend this person money? Well, with the reverse mortgage, the risk is really the length of time that you're in the home. So that's why the amount that they lend out is determined based on your age. So for instance, someone who is 82 can borrow less than someone who is 62, because they're basically banking that the person who's 82 is going to be in their home less time. So if you're in your home, you get a reverse mortgage. For instance, in my situation, the second I'm available for a reverse mortgage, I'm running down to the bank to get one, because once I turn, let's say 62, let's say, God willing, I live to 102. Well, I would be in the house for 40 years and never had to make a mortgage payment. Let's say my mortgage payment at that time is $1,500, we'll just say. Well, that $1,500 is something that I can just put in my pocket instead of having to pay my mortgage payment with. So, there's a lot of different ways that people are using this program, and that's one of them, is to increase the cash flow, which is really the key with this program and with others. So minimal income qualifications. Again, the risk assessment's completely different because there's no monthly payments. Same thing with many of these are adjustable rate mortgages. Well, people hear that term and then, oh my gosh, no way. I don't want an adjustable rate mortgage. Well, the reason people say that and the reason people balk at that is because traditionally, if you have an adjustable rate mortgage and those rates go up, guess what? Your pocketbook is going to get hit that same month. So you're going to have to come out of pocket more money. Well, if a rate adjusts on a mortgage that doesn't have a required monthly payment, it's not going to hit your pocketbook. Now, I'm not saying that that's not going to increase the loan balance. It will increase the loan balance at a higher clip, but you're not going to feel it. And I have many of my clients that have done these reverse mortgages, the peace of mind that they have that, well, if they plan on living, this is a program that's really designed to keep people in their homes to age in place. So if you want to age in your home, this is a great program for you. If it's a home that you're going to sell in the next couple of years, probably not a good idea to do a reverse mortgage. But if you're going to age in place, if the rate goes up, the rate goes down, it doesn't matter. You don't have a housing payment and you're living in the house that you want to live in for the rest of your life without having a housing expense. I always, when I speak with people, people will ask me my opinion. Would you get a reverse mortgage? And I always tell them, look, I'm biased. I'm drinking the Kool-Aid. I'm hook, line, and sinker with the reverse mortgage product. I've seen what it's done for my clients' lives. I've seen people's lives change overnight with this program. Don't ask me because I'm going to tell you all the good stuff about it. What I urge people to do when they're asking and trying to find out an unbiased opinion about a reverse mortgage, talk to someone who has one, not to your uncle who says, oh gosh, it's just a way to take your house. Or, there's a lot of financial quote unquote gurus out there that are telling people that, oh gosh, the reverse mortgage is a bad idea. And they don't even explain it correctly. It's one thing to call it a bad idea, but at least have some facts to back it up. So I encourage people, if you're looking for a reverse mortgage, ask somebody who has one, and they can tell you how it's working out for them. So more reverse mortgage information. The FHA administers the Home Equity Conversion Mortgage, HECM program. So you'll probably hear that term, HECM. That's just what HUD calls the reverse mortgage. According to the U.S. Department of Housing and Urban Development, more than 500,000 households, and that's actually increased quite a bit over the years, have a reverse mortgage. The amount of money available on reverse mortgage is determined again by the youngest homeowner. So I just had an estimate that I put together for a couple. The wife was 65, the husband was 55. Now, technically, you need to be 62 to borrow with a reverse mortgage. So the husband is grandfathered in, but we use 55 as the age to determine what's available, not 65. So if that makes sense. It's also based on the current interest rates. Higher the rate, less money you're going to be able to receive. And the value of the home, of course, that is the collateral still. The index is based off a monthly adjusted rate if you choose the adjustable rate program with the CMT, which is a index that they use for financing. Here's some benefits of the reverse mortgage. You get to keep the title to your home. There's a sentiment out there that you lose title, that the bank is trying to take your home. They're not trying to take your home. You don't lose title. It's just like any other mortgage. It's like saying that if you did any other 30-year fix that you would lose title to the home, or if you did a 15-year fixed, based on the premise that you have a lien on the property. If you have a forward mortgage, if you have a home equity line, if you have a 30-year, a 15-year, you have a lien on your property with the bank. So technically, do you own the house? Yes, you're the owner, but you have a lien against that property. Same thing with the reverse mortgage. There's a lien once you pay it off. For instance, if you at the end, that's a lot of questions. I get a lot of questions about that. What happens when I pass, or if I get moved to a facility, or if I sell the property? Well, basically, if you pass, this is the most friendly program that you can be in that situation, because your heirs are going to get 6 months to decide what to do with the property. And then they're also going to get 2 free 3-month extensions. So a total of 12 months to determine what to do with the property. Whereas with a forward mortgage, the clock is ticking. If you get delinquent 90 days on your mortgage, then they can initiate the foreclosure proceedings. At least here in Colorado, they can. The bank doesn't want to foreclose on homes, but they can. So with a forward mortgage, that clock is ticking because you got to crack that nut. So if in a situation where you pass, they still want that mortgage payment. There's still an agreement that says, hey, we want to get paid each month. With a reverse mortgage, it's much friendlier process because they're kind of designed for this type of thing. So there are basic credit and income qualifications, tax-free cash from equity. So if you pull equity out of your reverse mortgage, it's not considered taxable because it is a loan. And monthly payments are optional. Again, there is a monthly payment, but it is optional. So you're still responsible for maintenance, taxes, and insurance as long as you occupy the home. So the 2 biggest myths that I come across with the reverse mortgage program is, 1, you lose title to the home, and that you no longer own the home. Completely false. And 2, that you're upside down on the property after you take one out. it is possible to go upside down on a reverse mortgage, especially if the housing market slows. I was just speaking with one of my great agent friends today at Remax, and he had a sales meeting. They got the rah rah, real estate agent, go get him, Tiger, sales meeting, and they had one of their title reps come in and talk about the stats of the month of the housing market. Well, it's not as bleak as people are making it out to be. I mean, the prices have still gone up despite the huge slowdown with the housing market. And the main reason is inventory. Inventory is still really, really low. And it's the old adage, housing markets or any type of markets have a really take on a life of their own. So supply and demand tells us if you got a low supply, you're going to have a high demand, and that's going to drive prices up. So those things are completely false. So let's talk a little bit about retirement in America. So these are the three buckets of finance. So you have your first bucket here. You have your income. You have your second bucket, which is assets. And then you have your third bucket, which is home equity. So pre-retirement, income is coming out. You're making income with your job, and you're putting that into your savings account, your 401, and you're also putting that into your home equity as well. So right now, most people are underprepared for retirement, especially here in America. Less than 1,000 people, according to the 2019 Retirement Confidence Survey, about 26% of the respondents said they had less than $1,000 saved for retirement. Now, if you want to, well, this is basically the percentage of what people said they had. 26%, the largest group, said they have less than $1,000 saved for retirement. So the unfortunate thing is that most Americans aren't saving for retirement, and those who aren't saving enough. That creates a pretty big issue down the line. Again, we come back to our three buckets. Prior to retirement, you're taking income, putting it into your assets, and then your home equity, you're paying down your mortgage. So post-retirement, these buckets change quite a bit. Number one, this first bucket gets much smaller because a lot of times we don't have the same income that we had during our years that we were working. We're on a fixed income, Social Security, pensions. Pensions are really a thing of the past. In the 70s and 80s, they gutted those and hey, here's your 401k. But pensions are, some government agencies still have pensions, and wow, what a great way to retire. But those of us who don't have them are going to be, living off of Social Security, fixed income, or passive income. If you've set yourself up to make money while you sleep, which is really the name of the game for everybody, passive income, that's ideally what you want. But more often than not, that first bucket does get smaller. It shrinks. Well, the second bucket, your savings, becomes vitally important. As you can see in the depiction there, it's in a throne. It does become your crown jewel, mainly because that's the cash that you're going to live off of while your cash flow is low. So, the biggest concern that most of my clients have with that second bucket is running out of funds prematurely. And it's a story you hear every single day with people in retirement, that they have not saved enough, or they squandered their funds too. I mean, I've been called out by some of my financial planners that asked me to meet with people who are really in desperate need of a reverse mortgage. We have several types of clients. People use this as a financial planning tool. Some people use it as to bail them out, basically. And, I had a fella, he had about $500,000 in his savings, and he squandered it within 2 or 3 years. And it's like, how did you do that? Well, I went out to visit him. Well, both of his adult children are unemployed. They're living in the basement. They're not really contributing. So he's basically was supporting his whole family with his retirement funds. And now they're in a situation where they've almost depleted all of those funds. They still have a mortgage payment to pay, and it can get quite dire in a situation like that. So by converting, I think their payment was like 2,000 or something like that. Converting that monthly mortgage payment, that 2,000, you got to crack that nut every single month to make that $2,000 payment. So instead of doing that, basically, we've converted that to a payment optional program. So what that does is that now he's got an extra $2,000 a month that he can live off of. Now that he's squandered that savings, but now at least he's got a little bit of relief, knowing that he's not going to have to ever make a mortgage payment if he chooses not to, and he's going to be able to live in the property the rest of his life. So as long as he's alive and living in that property, well, I guess his adult children are going to be sheltered as well. The green bucket, which is your home equity, usually you have a lot of home equity post-retirement because you've worked so hard over the years to pay off that loan. So you have equity built up, and that becomes a larger bucket post-retirement. So this is pre versus post-retirement buckets. Pre-retirement, again, you're putting money from your income into your assets and into your home equity. Post-retirement, these buckets change quite a bit because, one, your cash flow is limited with income, your savings becomes vitally important, and your home equity is usually abundant and just kind of sitting there idle. That's why it's my assertion, if you should not be paying a mortgage payment after 62. And the reason I say that is that, well, number one, housing is your biggest expense. And if you have a smaller income, if you got a smaller red bucket, then you're going to need to shift some things around so that you can live a better quality of life and not have to work into your 70s and 80s to make it. So basically, if you're still paying a mortgage payment after 62, you're either taking it from bucket number one, which is your small bucket, or you're taking it from bucket number two, which is really your crown jewel. You want to hold on to your savings as long as you can, frankly, because you don't know how long you're going to need it for. So, for instance, they have the Smuckers commercial, and it used to be that there was just one or two people, celebrating their centenarians, 100 years old, and I remember when I was growing up, there's one or two people on the Smuckers commercial. Now you tune in and there's 10, 12 people becoming centenarians, over 100 years old. So we're living a lot longer, which does create a lot of issues and concern about running out of cash prematurely. So really establishing an increase in cash flow in retirement is going to be the best way for you to live a healthy retirement. And right now, there is a lot of equity in senior housing right now. There's over 6 trillion in equity right now across the nation for home equity. And the thing is, I've had, countless clients that, live in a house free and clear, yet they're eating bologna sandwiches every day because they don't have the cash flow to support themselves. So what ends up happening is that they run out of cash, and usually the advice that they get from family or from financial planners or whoever they're going to for advice, sell your house and go into a facility, or sell your house and rent. Well, if you talk about going into a facility, if you've ever seen someone's life savings get liquidated in a matter of months, in a lot of cases, the private care facilities are very capable of doing that. I know here in Colorado, the average room for a 24-hour care facility is over $10,000 a month. $10,000 a month. So we're talking $120,000 a year to stay in one of these facilities. So, a lot of folks will talk about, different ways to shift things around. But at the end of the day, housing is your biggest asset. It always is going to be your biggest asset for anybody. I get on my soapbox, with the first-time home buyers and folks who are kind of on the fence. Do I want to buy? Do I not want to buy? Well, folks who have not bought real estate and are in a position where they are short on cash or short on cash flow, they're stuck. I mean, there's really no other options other than becoming someone's roommate or basically moving in with family, things like that. And that's nothing's wrong with that. I mean, that's something that a lot of folks would end up doing. But you have a lot more freedom if you're able to leverage your equity for victory. And that's really what the reverse mortgage does. So again, what is equity? It's a lot like having that glass coffee table right in the middle of your living room full of cash that you can't get to. So it's cash that's not accessible unless you sell your home or you take a loan and pay it back with interest. Does it really benefit you in retirement? Not really. You can't take a picture of your house and go down to the grocery store and show the cashier your house and pay for your groceries or pay for your gas. They might look at you a little funny if you try that. So I wouldn't suggest that. Is it better to pass on a higher net worth or more equity? That's really the key that I think a lot of people miss with this program. For instance, let's say you have a $2,000 mortgage payment and you want to aggressively pay it down and you're in a 30-year fixed and you refinance and you get a nice new rate. Well, keep in mind on a 30-year fix, you're paying 50% of the interest in the first 10 years of that note. So what does that mean? That means your first 5 years, you're basically taking your hard-earned retirement, your hard-earned cash, whatever you're using to make that money, whatever bucket you're pulling out of your income, or maybe you're pulling out of your savings, you're handing it right over to the bank in interest. Right over. Hey, here you go, bank. Take my hard-earned cash. That's how the 30-year amortization works. And 15 years, a little bit better, but you're still in an amortized schedule. So let's say you have a $2,000 mortgage payment, and for the first 5 years, probably 200. First couple payments, maybe 200 is going towards paying off the principal, and then you got 1,800 going to the bank in interest. So a lot of people look at that and they say, you know what if I converted that $2,000 payment into a payment optional program and took that $2,000 that I would normally be making my mortgage payment with? How about I just take that and put it in my pocket? Because if you're able to do that, now you can direct it. Now you can say, okay, well, I can put this into an investment. I can open up life insurance policies on my kids, on my grandkids. I can, afford to buy a new car and make the payments. But the point is that you're directing that. Yes, you are sacrificing some of your equity to do that. But at that time, it makes a lot more sense to be able to do that. And the peace of mind is also something that comes along with that. And as I get older, as I age here, peace of mind is very valuable to me, very valuable. So what do people usually do with a home that's bequeathed? A lot of times people will look at this and say, well, I want to pass, the home on to my kids, and I don't want to eat up all that equity. Well, a lot of times what the kids will do when they get a home, very few of them will keep the home. They basically will sell that home. 9 times out of 10, they're going to call a real estate agent and have them sell the property for them. So they're not really interested in the equity so much as they are the actual cash value of the property. So does cash do better in your pocket or locking it up in your home? Again, it's the whole adage of, I have folks that come to me and say, hey, should I pay cash for a property? Well, I don't think paying cash is a great idea. Of course, I'm biased. I'm in the lending industry. The guy who's offering loans says it's a bad idea to pay cash. Well, the reason I say that is that if you do pay cash, you lose all control over it. Let's say you pay $400,000 cash for a home. Well, that $400,000, now you've put that in the hands of a bank or a buyer. If you need to get it back, because if you want to get that $400,000 back out, you got to call the bank or you got to call a buyer to purchase the home. So it kind of handicaps people a little bit. We ran out of time prematurely here, by golly. It's 2:30. I try to keep these to a half hour. There's a few more slides we'll go through, but we'll go through those on the next week. So same bat channel, same bat time. Feel free to give me a call if you have questions. You can always visit us at chariotreverse.com or happyhousetoday.com for more information. Thank you so much for tuning in today, and I hope you have a great rest of your day. Many blessings to you and yours, and may blessings rain down on you like 1,000 suns. Thank you very much.